Hi, this is Marita. Today I want to break down step by step how to analyze a rental property if you're brand new to the real estate investing. Whether you're buying your first investment or just curious about how the pros crunch the numbers, I'll make this very simple, practical, and actionable. Start with the big picture. Why analyze? Before you ever buy a rental, you need to know if it's actually going to make you money. A lot of rookies skip this step and just hope for the best. And that's how you end up with a money pit instead of a cash cow. So let's dive into the basics of property analysis. Estimate the fair market value. First, figure out what the property is actually worth. Use a comparative market analysis, CMA. Look at what similar properties in the area have sold for recently. Check online resources like Zillow, Realtor.com, or even reach out to a local real estate agent to help you run the comps. For a quick estimate, you can use the 1% rule. If a property is listed at $500,000, you'd want to see at least $5,000 a month in rent. But this is just a starting point, not a guarantee. Determine the market rent. Next, you need to know what you can realistically charge for rent. Don't just trust online estimates. Pretend you're a tenant and check out what the similar homes are renting for on sites like Rentometer, Zillow, or Rent Cafe. Call around, talk to landlords, and look at properties with similar size, condition, and amenities. Be conservative. Overestimating rent is a rookie mistake. If the numbers still look good with a lower rent, you're in a safer spot. Calculate all expenses. This is where most new investors get tripped up. You have to account for every cost, not just the mortgage. Here's what to include: mortgage payment, principal and interest, property taxes, insurance, repairs and maintenance, property management fees if you're not managing it yourself, HOA dues if applicable, vacancy allowance planned for a month or two per year with no tenant, utilities if you're covering any of the tenants. Add all these up for your total monthly and annual expenses. Run the key numbers. Now let's crunch the numbers. Here are the big three. Cash flow equals total rent income, total expenses. If you're making $7,000 a month in rent and your expenses are $6,000 a month, your cash flow is $1,000 a month or $12,000 a year. Cap rate, net operating income, property value times 100. NOI is your income minus all expenses except your mortgage. A good cap rate varies by market, but 6 to 8% is a common target. In Silicon Valley in particular is closer to 4 to 5%. Cash on return equals annual cash flow, total cash invested times 100. If you put 150 down and your annual cash flow is 12,000, your cash on cash return is 8%. Stress test your numbers. Don't just look at the best case scenario. What if you have a vacancy for 2 months? What if repairs are higher than expected? What if rents drop? If the property still works with these what ifs, you're on the right track. Do your due diligence. Finally, before you buy, inspect the property for hidden issues. Review the lease and tenant history. Double check your numbers, ask questions, and get everything in writing. Remember, analyzing rental properties isn't rocket science, but it does require attention to detail and willingness to be honest with yourself about the numbers. If you follow these steps, you'll avoid the rookie mistakes and set yourself up for a long-term success. If you want more tips or a copy of my rental property analysis checklist, drop a comment below or reach out directly. I'm always here to help out. Marita with the Walker team. See you in the next video. Bye-bye.